Welcome to the Texas REIAs. The Texas REIAs is the largest by far network of real estate investor associations in the great state of Texas. And we've got a couple of very minor little technical problems here. Let me plug the right thing in and get started here. So if you have the slightest interest in real estate, the very first thing to do is to go join your local real estate investor association. And my job tonight is to make you all into educated and contributing members of this community. So let us go ahead and get started. The Texas REIAs has chapters in Austin, Dallas, Houston, and San Antonio, provides resources for real estate investors. Over 150,000 members, participants, and attendees going back to 2003. And what kinds of resources do we provide? Training, power teams. Some of you were here early, saw some of those little pop-ups. Those are power teams. You need money, we have money. You need tools, we have tools. You need market data. We're going to do a market update tonight for you guys. If you need training, we have training. If you need a network, we have a network. Just about everything you need to be a real estate investor. Because being a real estate investor is a team sport, or if you really want to scale it up, you really need to be part of a team. So we're going to start tonight with a market presentation, a market update, and specifically we're going to talk about what's going on in today's market. So, what is going on in today's market? What's the big news in real estate right now? What's changed over the last year or so? Interest rates changed, got it. Okay, what happened to interest rates? They went up. So they're different, right, than they used to be. Okay, let's talk about that. So who would say, and I'm going to do a little audience participation, right? And there's no right or wrong answers, right? I'm going to ask for your opinions. Opinions cannot be wrong, so you can't vote wrong, but I do want everybody to vote like one or two, right? So like, what do you think? Do you think interest rates are high? Do you think interest rates are low? Let's do a little poll of the audience. Who thinks interest rates right now are kind of high? Who thinks interest rates are high? Okay, who thinks interest rates right now are kind of low? Who thinks interest rates are low? Okay, we're clearly not getting all of our participation. There's only two answers. They're not no right, no wrong. Okay, so let's try this again. Who thinks interest rates are kind of high right now? I kind of want to know. What do you think? Who thinks interest rates are kind of low right now? Kind of low. Wow, okay, look at that. We got a lot of highs and a decent set of lows. Okay, my opinion is interest rates are normal, but that's just my opinion. So I have been investing in real estate since 2003. I've got a lot of properties. I own about $30 million worth of rental houses in Texas. That's like the smartest thing I did, was buy a bunch of rental properties along the way. And most of my rental properties have a mortgage between 6.5% and 7.5%, which by all historical measures is normal. Now, a few years ago, you could get a mortgage of 3%, okay? You could get a mortgage of 3%. Now, before that, prior to that, when was the previous time that you could get a mortgage at 3%? Does anybody know? That would be never. It did not happen in your parents' lifetime, in your grandparents' lifetime, in your great-great-great-grandparents' lifetime. Never. It's never happened before. Now, when do you think we're going to get back to 3% mortgages? Anybody want to guess? I would guess never. I don't know. And you don't know. I can't tell you what's going to happen in the future. I don't even try. But I would guess that the odds of that ever happening again are approximately the square root of zero. I don't know, right? But you know, the things that would have to happen to make that happen, you're probably going to be more concerned about getting bullets for your AK-47 and fighting off the zombie apocalypse than you are about interest rates. I mean, I don't know. We don't know. Okay? But I would say by all historic standards, interest rates are normal. Now, interest rates are normal. This is interest rates, by the way, the blue line here, going all the way back to 1970. From 1970 to 1981, interest rates on mortgages got all the way up to 18%. So for anybody who's belly aching about 7%, how about 18%? You know, comparatively speaking, money is on sale, okay? So yeah, certainly different. Now, but I would argue they're normal. This is normal. And personally, I like normal. I like normal a lot. I don't like abnormal. As a real estate investor, I like things that are normal. I don't like things that are abnormal. And I'll give you an example why. Like, I invest in both residential and commercial, in active and passive. I love them all. And we're not here to try to persuade you. We're not here to sell you something. We're not here to persuade you of something. We're going to give you a lot of data and information, and we do it all. We love it all. We do all the strategies. We have people that do everything, commercial, residential, active, passive, whatever. And we're going to give you all the data and support you in whatever direction you want to go in. But the reason I like normal is because when things are normal, they're just more predictable. So for example, 3% mortgages. A couple of years ago, people were buying apartment buildings. That's one of the many commercial things we do, apartment buildings, multifamily. And it was very competitive, hyper competitive. And because it was very competitive, they were paying top dollar. So a few years ago, people were paying top dollar to buy apartment buildings. And then they were getting financed with 3% mortgages. And the numbers worked, because if you could buy something, even at top dollar, you get it financed with a 3% mortgage, you could still collect enough rent, right, to pay the mortgage at 3%. But here's something about commercial. Commercial deals, commercial loans are not 30-year loans. Residential loans are 30-year loans. Commercial loans are like 5-year loans, right? And commercial investments tend to be like 5-year investments. They don't have to be 5, but a lot of it's geared to 5. Like if you invest in a commercial syndication, it's probably a 5-year deal, because nobody wants to tie their money up for 30 years, right? If they say, hey, you want to invest in this thing, you might invest in something for 5 years. You're probably not going to be interested in investing in something for 30 years. So all of these commercial deals are created to turn over like every 5 years. So a few years ago, people were buying these properties, right, at top dollar, financing 3% interest, and now those loans are coming due. And now they're trying to resell the properties, because that's what you do every 5 years. And the new buyers, well, first of all, the market's not as hot, so they're not paying top dollar, but if they even bought them for what the prior guy bought it for, the numbers don't work. Because at a 7% mortgage, you're not going to collect enough income, right, from the rental property to pay the mortgage. So we got problems, right? And some of those properties and deals are failing, right? And like with commercial real estate, you know, some of you may know the famous quote from Wayne Gretzky, the famous hockey star, right? He always said, I don't skate to where the puck is, I skate to where the puck is going. So like if you're doing a commercial deal, you have to ask yourself the question, if you're going to flip something in 5 years, what's the world likely to look like in 5 years? Now, you don't know. Nobody knows what the world will look like in 5 years. But if the interest rates you're buying at are 3%, right, that's never happened before in the history of humanity, right, or even in the dinosaur ages, it's never happened before, right? Is that a safe bet to believe something that's never happened before is going to continue? I would say that was not a very smart bet. Now that interest rates are 7%, which by all historical standards it's normal, right? Is it a reasonable bet to guess that probably in 5 years, interest rates will probably be around 7%, give or take, maybe a little better, who knows? I'd say that's a safe bet, right? And that's why I like normal. It's just safer to invest in things that are normal than it is to invest in things that are abnormal. That's just my opinion. Now, let's go for another opinion of the audience. And again, opinions can't be right or wrong. So I'll give you two choices. You vote for one or two, and you can't be wrong. What do you think? When interest rates go up, what happens to home prices? Do you think they go up or do you think they go down? Let's do a vote. Who thinks when interest rates go up, home prices tend to go down? Who thinks when interest rates go up, home prices go down? Okay, who thinks when interest rates go up, home prices go up? Okay, we got a bunch of downs and a couple of ups. So this is where I will give you some data. Historically, when interest rates go up, home prices go up. Isn't that interesting? Why? Well, it's a little counterintuitive, isn't it? So here's the thing about home prices. Home prices really don't care about interest rates. They don't care about the economy. They care about two things, supply and demand. It's all supply and demand. Okay, so in as much as interest rates or whatever affects supply and demand, yes, it will affect home prices. Now, when interest rates go up, for sure, mortgages are more expensive. meaning they're less affordable, meaning less people can afford them. And when less people can afford them, reduces the demand, right? And that pushes prices down. So for sure, that directly pushes prices down. But there are other forces to consider. What are some of the other forces? Why did we raise interest rates? To battle what? Inflation. Okay, usually when they talk about inflation, they always talk about it like it's this bad thing. We have to whip inflation and get inflation under control and stop inflation, right? And they always talk about like inflation. They always use these bad words to describe inflation. Now, personally, I disagree. Personally, I love inflation. Okay, I just have another name for it. You know what I call it? I call it appreciation. Same thing, guys. When you have inflation, it means the money becomes worth less, right? What becomes worth more? Everything else. Your money buys less. Less what? Less gold, less real estate, less whatever. So when you have inflation, the value of the money goes down because the value of everything else goes up. You want your money not in money. You want it in gold, you want it in real estate, you want it in assets. Okay, so who's owned a house for the last 3 years? Who's owned a house for the last 3 years? Nice. You're a lot richer than you were 3 years ago. Congratulations. By the way, what if you own 20? What if you owned 100? What if you own 200? Can't go back. Going forward, you can do anything you want. Ask you another question. So yeah, anybody that owned a house for the last 3 years is a lot richer because of inflation, appreciation. Right? So congratulations, which pushes prices up. And by the way, when you're talking about houses, let's ask another opinion. Who thinks houses are kind of expensive right now? Raise your hand if you think houses are kind of expensive right now. Who thinks houses are kind of cheap right now? Who thinks they're cheap? Who thinks they're expensive right now? Two choices. Okay, who thinks they're really cheap right now? Okay, we got a lot of expensive and not many cheaps. Okay, my opinion, they are dirt freaking cheap. I can't believe how cheap these houses are. They're practically giving them away. I mean, oh my gosh, they're the cheapest houses. Man, they're giving these houses away. I can't believe it. And you know, if you don't believe me, here's what I want you to do. I want you to ask somebody that I know that you trust. I want you to have a little conversation with somebody that I know you implicitly trust. In fact, the person I'm going to tell you to talk to is probably somebody you trust more than anybody else in the universe, okay? So I want you to have a conversation with future you, okay? I want you to talk to yourself 20 years in the future, right? And I want you to ask that person, future you, what do you think about the cost of houses, okay, in Houston in 2024? And you know what future you is going to tell you? Yeah, exactly. I can't believe it. You could actually buy a house in Houston for less than $2 million. You should have bought them all. The smartest thing I did in my life, 20 years ago, I got into the real estate thing, and I bought myself a whole bunch of houses as rental properties. At the time, I thought, oh my God, these houses are so expensive. I can't believe how expensive these things are. You know, I had to pay $110, $120. Some of these houses I had to pay like $150,000. I think I paid $175 for one of them. I couldn't believe how expensive they were, but I did it anyway. I bought those houses at those ridiculous prices, and now those houses are worth $500, $700. I got a couple that are worth more than $1 million, right? And while I've held them for the last 20 years, I just basically bought them. I took the keys, I handed the keys over to a property manager. I said, see you in 20 years. That's pretty much how I do it. Because managing a property is not something you should spend even 1 second on, right? And over the last 20 years, you know what happened to those houses? They doubled in value, and they doubled again. Some of them doubled a third time. A few of them doubled a fourth time. And the tenants have paid off the mortgages. It's freaking awesome. So now that portfolio is worth $30 million. Right? And what did I do? I just bought a bunch of incredibly expensive houses at ridiculous prices, and I handed the keys to a property manager, right? And I'm coming back 20 years later and say, so tell me what I got. Right? That's what I do with rental properties. So if you think houses are expensive, every year people complain that houses are expensive. Every time people get in this real estate thing, it's the same thing. I've been watching this for 20 years. Oh, these houses are so expensive. Okay, but getting back to interest rates. Interest rates are higher, right, because of inflation, which is pushing prices up. Something else is happening, interesting, on houses. Back in 2002, 3, 4, 5, 6, 7, right, we had subprime lending. Remember that? Yeah, everybody could get a loan. If you wanted to get a loan in 2005, you walked into a bank. The loan application involved putting a mirror under your nose. If they saw fog, you got a loan. That's what they used. And then in 2008, all the banks went bankrupt, right? But from 2002, 3, 4, 5, 6, 7, money was easy, free and easy. And everybody could get a loan. So they were building houses out in the horizon in every direction as far as the eye could see. We built bazillions of houses. And what did they do with all that inventory? They gave everybody a loan. Anybody could afford a loan could get a loan. And then in 2008, the banks went bankrupt. Well, they were too big to fail, weren't they? So we bailed them out. We didn't let them quite go bankrupt. But lending in 2008, it came to a stop. It didn't slow down. It was like a train that hit a wall. It just stopped. I was there, it just stopped. And you had all this supply, houses out in every direction as far as I could see, and then the demand just stopped. And what happened to the real estate market? Crash. All right, lots of supply, no more demand. Now, eventually, the banks got back into the business of banking, lending. But even though they started lending again, today, all these years later, now what do you have to do to get a loan? What do you have to do to get a loan? Turn over your firstborn, submit blood samples, fill out a 1,900-page application, right? A lot. You have to do a lot to get a loan. And consequently, there's 80 million Americans that can't get a loan, right? So yeah, money got cheap, but it never got easy. And because it never got easy, we haven't been building enough houses. And I don't know if you know this or not, but on a national basis, we're in the middle of a housing shortage. Who's heard that we're in a housing shortage? Yeah, we have 6 million fewer houses than we need. And we don't have enough supply. What does that do to home prices? Pushes them up. We got another thing going on with the market. Right now, the economy is not bad. It's not great, but it's not bad, right? And people have jobs. The unemployment, very low, so people have jobs. Their IRAs have gone up. The economy is not bad. Right now, you know what should be happening? People should be saying, hey, let's buy another house, right? But there's some funny things going on, right? Let's sell our house and get a new house. But there's some funny things going on. What's going on? Historically, 2/3 of the houses that you see for sale are resale, and 1/3 are new construction. Right now, it's inverted. Right now, it's 2/3 new construction, only 1/3 resale. Why isn't anyone selling their house? Because they got a 3% mortgage and they don't want to give it up. So all that supply that should be going on the market, people should be selling their homes and buying bigger, nicer homes, but they're not, right? They're holding all that supply off of the market, contributing to the housing shortage, right, which is also pushing prices up. So we have things pushing up and we've got things pushing down, right? Now, I'll show you an interesting statistic going all the way to 1981. Interest rates went all the way up. This red line here is median home prices. When interest rates went up, look what happened to home prices. They actually went up a little bit. And then when interest rates came down, home prices went up again. And when interest rates went up and down and up and down and up and down, let me show you up and down and up and down and up and down. There's up and down and up and down and up. Home prices still went up. Now there's some bubbles. There's that 08, 09, 010 bubble. There was a big bubble, right? We had little bubbles, so we have some bubbles. But it's not as simple as to say interest rates go up and home prices go down. Now what does happen is the volume goes down. The number of buyers goes down, for sure. But because the number of sellers also goes down, that's really what affects prices, both the buyers and the sellers. So we have fewer buyers, but we also have fewer sellers. And when you put all that into a blender and push the button, where are we? And the answer is the market is flat. The market is flat. Now, let's talk about that. The volume's down a little bit, but the market's flat. So what I'm going to do is I'm going to go through the different cities and kind of show you what's going on a city-by-city basis. But first we'll talk about Texas. State roundup. The average price house in the state of Texas, $433,000, up 1.5%. It's basically flat. Median price in the state, $345,000. Year over year, it's flat. So here's the number I think is the most important number to kind of watch. If you want to know kind of really where we are, where things are going, look at inventory. What is inventory? The best way to explain inventory would be this, okay? If we took all the houses that are for sale on the MLS for sale, and we stopped adding any more houses for sale. So we're just going to take the houses that are for sale, and we're not going to add any more. The question is, how long would it last before we're out, right? How long before the shelves are empty? And the answer is 4.7 months. 4.7 months. Now, to put that in perspective, that's also the average amount of time it takes to sell a house. Some more, some less, average 4.7. Now, to put it in perspective, here's the saying. If there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you have a neutral market. We still have a seller's market. Isn't that interesting? Now, it's a weak seller's market. Last year, we had 3.3 months of inventory, which was a strong seller's market. So we get back into this question of perception. Some people are saying, oh, the market's bad. Compared to a year ago, yes, it's not nearly as hot as it was a year ago, but by historical standards, it's still a pretty good market. In fact, I would call it a normal market or even a slightly better than normal market. And I do feel like I do need to issue a little disclaimer at this point. We're not here to try to persuade you of an opinion, okay? All of this data comes from the Texas A&M School of Real Estate and a number of online sources. We've been doing market updates and market forecasts for 20 years. When the market is going up, we tell people the market's going up. When the market's going down, we tell people the market's going down. When it's going sideways, we tell them it's going sideways. There are a lot of groups out there, one being the National Board of Realtors, who, as far as I can tell, for every year for the last 20 years has been telling us the market's going up, whether it's going up or down or sideways. We have strategies to make money in up markets and down markets and sideways markets. So we just present the data, and we will give you a forecast, but we're going to tell you we don't have a biased opinion. We're not trying to persuade you. I'm not trying to offer you some investment and trying to persuade you that the market's doing anything in particular. A little bit more data, historic data. 2021, prices went up 18% in 1 year. 2022, they went up another 10.7% in 1 year. 2023, it went flat. So the market went way up a little more, and then it flattened out. The volume's down. Less buyers for sure, but also less sellers as well. Okay, Houston, let's talk about Houston. The average price house in Houston, $445,000, and it's up. I think Houston is actually, I don't want to say hottest, but it's the prices are up in Houston a little more than I think all the other cities. 4.7%, that's actually kind of more than just flat, it's up a bit. Median price in Houston, $350,000, up 3%. Sales is even up a little bit, basically flat, but up a little bit. It'd been going down, down, down for a long time, leveled out, started to pick up a little bit. Months of inventory, 4.3, a little better than the state numbers. Lease prices are up a little bit. Now this is commercial, multifamily. The rest of this is residential. But when it comes to commercial, when lease prices are up, what does that tell you about commercial, like about apartment buildings? They're full or they're empty? They're full. Yeah, they're full. So leases are even up a little bit. Going back to historic data, 2021 pricing in Houston went up 16% in 1 year. 2022, they went up another 10%. 2023, flat. So very interesting. Dallas, big D. Dallas, the average price house is $525,000. Up 2%. Dallas is the second most expensive major city in Texas. Median price, 410, down 1%, we'll call that flat. Closed sales up a little bit, 5%, 3.9 months of inventory. It is the hottest market in terms of inventory in Texas. Last year it was even on fire at 2.5 months of inventory. This year it's pretty good, 3.9 months of inventory. And I'll tell you something about Dallas. I've never figured out why this is the case, but for some reason, Dallas has always been the bellwether of Texas. If you kind of want to know where things are going, you look at Dallas. You look at inventory. Inventory gives you a hint of the future. Dallas gives you a hint of the future. Condominiums is another thing we always take a look at. We call condominiums the canary in the coal mine. Why is it the canary in the coal mine? First thing to go, last thing to come back. So if the condo market is hot, everything's hot, right? If condos are hot, everything's hot. When the thing started as soft, condos first thing to go down, right? The inventory starts to climb. And then for some reason, Dallas has always been a bellwether. I don't know why. 2021 prices in Dallas went up 20% in 1 year. 2022 up another 15% in 1 year. And then 2023 up 1%. We'll call that flat. Lease prices in Dallas are flat. Okay, what else? Austin. Now, Austin is an outlier, and I'm going to tell you why. In Austin, the average price house, $574,000, down 3.4%. 500. That's the average price house in Austin, Texas, 574. You know, and we did a little research trying to figure this out. Like, why is that? And it turns out Austin, like, where'd the name come from? It turns out Austin is actually Latin for San Francisco. Okay, yeah. Elon Musk moved to Austin, and Meta and Apple and Amazon and all these high-tech companies moved in with all these six-figure engineers and high-tech people, and prices just went crazy in Austin. Median price, Austin, $450. Median price, down 2%. Months of inventory, 4.8. Not bad. Still a buyer or a seller's market. Not as good as it was a year ago. But what's different about Austin? I'll tell you what's different in Austin. Here's what's different. 2021. In 2021 in Austin, Texas, prices went up 29.3% in 1 year. And I was there. Yeah. In 2021, remember inventory, months of inventory, in 2021, Austin, Texas had 0.4 months of inventory. That's less than 2 weeks. In 2021 in Austin, Texas, somebody would put a house for sale, they'd get 11 offers in a weekend. 1 would win, 10 would lose. So the 10 that lost would put an offer on a second house, they got 11 offers in a weekend. 1 would win, 10 would lose. And this would happen over and over again until the buyers start screaming at their realtors, "You're giving me bad advice, I keep getting outbid, what do you have to do to buy a house around here?" And it got so crazy that in that unusual, abnormal year of 2021, it became normal in that abnormal year for people to buy houses at 5 to 10% above appraised value. Now, by the way, the lender will not allow you to buy a house above appraised value. The total down payment and the total loan cannot exceed, even by $1, the appraised value of a house. If you really want to buy a house above appraised value, you got to put the down payment, you got to get the loan, and then you got to pile a bunch of money on after that, which you could do if you really want to, but the lender will say we're not going to be part of that. But in that abnormal year of 2021, it became normal for people to buy houses 5 to 10% above appraised value. 2022 didn't get much better. Prices went up another 10.4%, and then 2023 went down 8%. So most of Texas went up 30% and flattened out. Austin went up 40%, came down 10 and flattened out. What's the difference? Well, it depends on when you bought your house. If you bought a house a year ago, you lost 10%. If you bought your house 3 years ago, you made 30%, just like everybody else. But that's perspective. And finally, we have San Antonio, the most affordable major city in Texas. And the average price house is $376, down 2%. Median is $320 flat. 5.3 months of inventory, the slowest market in Texas. Historic data, 2021 up 16%, 2022 up another 12%, 2023 flattened out. Down 2%, we'll say, is flattened out. So, where are we going from here? Well, let's take a look at what's driving the market. There's different things driving the market. First is their economy. There's the economy. Now, I'm going to tell you, real estate really doesn't care that much about the economy directly. Indirectly, it matters a little bit. Like if the economy is doing well-ish, then people are like, oh, you know, it's a safe time to buy a house. So people are a little more likely to buy a house when the economy is doing a little better. Consumer confidence. Consumer confidence is something that is people's opinion, confidence about the economy. And they score it on a 0 to 200 scale, right? Anything over 100, people are confident. Anything under 100, people are scared. Right now, we're right in the middle, 103, just over the middle. So people are not unconfident, they're slightly confident, which helps a little bit. Unemployment is low. Anything under 5% is considered solid employment. Texas has 4.1% unemployment. So we got jobs, and people that have jobs are a little more likely to buy real estate. Job growth. We are, yes, indeed, creating jobs at a pretty good pace. So that's helping a little bit. And then we have the stock market. Now, again, real estate doesn't care about the stock market directly, but it cares indirectly. People look at their 401k. And if their 401k is going up, they feel wealthier. And when they feel wealthier, they're a little more likely to go out and buy a house. So yeah, we ended last year really strong. This year's been kind of flat, but it's pretty good. And then we have interest rates. Interest rates, yeah, sure, they have gone up, making houses less affordable. So that's pushing prices down. House price trajectory, flat. That's a neutral. It's not going up, it's not going down, it's just flat. Closed sales trajectory down a little bit, but this one's starting to turn. Some of the cities are up and some of the cities are down. Pending sales trajectory, again, is flat. Texas is flat. Active listings, flat. Yeah, we're adding, but we're just keeping pace with demand, so that's also flat. Months of inventory. We're in a seller's market, right? Not a strong seller's market, but technically we're still in a seller's market with less than 6 months of inventory. Housing permits. Are we building enough houses? Not really. We got a lot of people moving here, and we're not really building enough houses for them, which gets us to this next bullet, which is migration. Now, this should be a triple-sized bullet. Not all of these things affect or drive the market to the same. This one is like a triple. This is a big one. Migration. What is migration? Migration is the ratio of people moving in versus people moving out. In other words, it's population growth. It's pure demand, because everybody that moves to Texas needs a place to live. Either they're going to live in a house, or they're going to live in an apartment, or a mobile home, or they're going to move in with somebody else, but they got to have some place to go. And we have a lot of migration. Last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where do you think they went? Yeah. And then there's 15 million other people. We don't know where they went, but I bet a bunch of them ended up here too. So there's a lot of people that are moving to Texas, and they need a place to live, right? So they're either going to buy a house or build a house or get an apartment or something. So that's driving up demand in a big way. And then finally, what else do we have? Construction labor growth. Okay, I'm just going to make this comment. General contractors are dying. We have a problem. They're aging out. The average age of a general contractor is 59 years old, and they keep getting older. So if you have a teenager, here's some advice. Don't send them to college. Buy them a hammer, okay? Just give them some tools, right? And you know, make them a contractor. They'll make way more money. They won't have to work for some jerk, and they will have no student debt. They'll make a fortune. Contractors are making more than college graduates. And now think about that. The world has changed, right? And we're not all caught up. I went to college, my parents went to college. I have a teenage boy. I don't really care if he goes to college. If he wants to go to college, you'll send him to college, but I think there's plenty of things you can do that don't include college. It's like I was reading this article about this surgeon who had this backed up toilet, and he had to hire, a plumber to come in and fix the toilet. So the plumber comes in and fixes the toilet, and gives the surgeon a bill, and the surgeon almost has a heart attack. Oh my God, this is ridiculous. These are the kind of prices that a surgeon would charge. And the plumber's like, yeah, I used to be a surgeon, you know. Yeah. Contractors are making a fortune. So I used to be able to build houses for like 120 a foot, and then it was like 150, 180, and then it's 200 a foot, and then it's 220, and then it's 250. Now I pay up to like $300 a foot to build a house. It's ridiculous. And most of it's labor. Materials are up too, but most of it's labor. So yeah, labor is really gotten expensive. And then we got some wild cards, right? There's an election going on, I hear. Interest rates, who knows? There's a couple of wars going on, et cetera. So I don't know. We got some things going up, we got some things going down, we got some things going sideways. Let's ask for the opinion. Who thinks, based on all of this, who thinks prices are probably going to go up from here? Who thinks prices are probably going to go up? Who thinks prices are probably going to go down from here? Okay, we got a lot of ups and a couple of downs. I don't know. I'll give you our forecast. We probably bottomed out about 6 months ago. So if you're waiting for the market bottom, that was probably it about 6 months ago, and it wasn't much of a bottom. Basically flattened out, and then it started to creep up. There's nothing big happening, with one exception. There's a very high probability that interest rates are going to fall. And that's what everybody expert says, probably going to happen this week. Did it happen today? It's supposed to happen, so any day now. Exactly how much, exactly how quickly, but all the money says it's going to fall. And if interest rates fall, that one big red bullet is going to start to turn green, right? But it's not going to fall a lot. It's going to fall a little bit, and it's going to fall gradually over time. But probably with the interest rates tweaking a little bit in the other direction, what we expect to see is that sales will be up a little bit and prices will be up a little bit. We don't see much dramatically changing. But if you look at all the things pushing things up and pushing things down, we're probably in a slightly upward trajectory. And that is our forecast. So was that helpful for you guys? Was that helpful, guys? Okay, great. We publish all of this data every month on our social media sites, so you're more than welcome to follow us on social media. It is useful to be a student of the market, right? As a real estate investor, it's good to be abreast of the numbers, right? Like the inventory number gives you the best indication kind of where things are going. You look at inventory if it's going up or down, right? Right now it's, you know, still a seller's market, but you know, people are putting houses on the market. They're like, oh, it's not selling in a month. Well, yeah, the average amount of time is closer to 4 months. So that's normal. You have to be prepared when you go to sell a house that it's going to take longer than it did a year ago. Good news, you know, it's still a seller's market, but it's not as strong as it was a year ago.